video, we're going to cover financial leverage. Imagine you're running a business and you have a brand new idea. Well, the very first thing that you need to establish your business is capital. Now, there are several ways in which a company or an individual can procure money. You have equity financing, you have debt. So which one do you think is best, right? Well, it's a very subjective question. However, there is a concept known as financial leverage, which basically explores this particular idea. Now, when I talk about financial leverage, the premise of this concept is that companies will use debt financing more than equity financing. And the reason that they do this is because it amplifies your earnings. What do I mean by amplifies your earnings? Well, simply put, once your fixed interest charges, right, or your debt repayment is covered, every single penny over and above that you earn in your business is retained as a part of your net income. So once your fixed costs have been covered, fixed interest costs, everything else is retained under net income. And this is a great way to magnify your earnings, right? You pay off your debt, but the money is yours and then you can keep reinvesting it into your business. So this essentially is the idea of financial leverage. Now that we've understood the basic premise of this concept, what type of companies use financial leverage or rather have a high degree of financial leverage? Well, to give you an example, FMCG companies will usually have a very high degree of financial leverage. So Unilever is a great example of a company who has high financial leverage. There are a few downfalls as well to having a high degree of financial leverage. Obviously, a small change in the tax rate will have a huge impact on your overall earnings. You also need to ensure that you're making enough money to be able to make your debt payments on time, your fixed interest payments on time. Otherwise, there's also a chance of you going bankrupt, right? So these are some pitfalls that companies obviously take care of. Finally, what is the formula to calculate degree of financial leverage? Well, it's very simple. So there are two ways of doing this. So the very first way of doing it is percentage change in net income, and you divide it by percentage change in earnings before interest and tax, or EBIT. Or the second way of doing it is just taking earnings before interest and tax and dividing it by earnings before interest and tax, and you just subtract the interest one apart. So yeah, so that's how you do it. Thanks for watching, guys.